Applied Materials just got hit by a Wall Street downgrade after earnings.
Is it justified given what their customers and their customers' customers are planning on doing versus what Wall Street is saying, which is just not in sync?
Let's talk earnings and favorite pastime.
So let me just say, earnings
Wall Street at 2.5x.
Because their compensation goes up.
Wall Street's wrong again. So Applied Materials just reported earnings earlier this month, and the headline number was, hey, they actually had okay earnings, but the stock completely puked, fell off 13%. And the reason why was because the fact that they were talking about a China pause in terms of whether or not they were going to be able to sell equipment in China, start up their things in China, whether or not we were going to have export license woes. And so the market panicked. And this was really, really funny because what it led to was a downgrade. A downgrade by Daiwa, which is a Japanese investment bank, who Applied Materials was previously an outperform, and now it's a neutral. And they lowered their price target to $170. And we just want to put this in context. Because what's funny is, the stock already dropped 13%. So if the stock already dropped 13%, what are you thinking in terms of saying, because the market already knows all that narrative that's out there, it's like, what is Daiwa focusing on here? And just for context, after the drop, here's where Daiwa is, They're basically saying this stock is doomed, everything is a problem. And Joel, the interesting thing is, if you think about it, a lot of the issues that Applied Materials talked about, AMAT, being the ticker, that Applied Materials talked about are all stuff that they're saying, hey, we just don't know, We don't know when the China stuff is happening or anything else. But one, I think you would argue, Joel, probably that's going to get resolved sooner than later. And two, it's clouding the fact that this stock this company is not as bad as people think, right?
Not at all. When we look at the accounting numbers, we're going to see a much better firm than the GAAP accounting Wall Street numbers would suggest by a lot. Look, this is still respectable 15 to 20% return. U.S. corporate average is around 12 to 13. Global corporate average is 6. So even on a GAAP basis, it's not a bad business. But in reality, from a uniform accounting standpoint, the company is crushing it with returns that are closer to 35 to 40%, 30 to 40% return on assets. Think about that. That is a return on investment, And we look at that return on investment over the last 5 years. We can then see, this is actuals based on uniform accounting, which of course you have to use. And then we look at AMAT or Applied Materials next 2 years based on the sell-side analysts' actual forecasts they put in front. They actually are saying that the returns are going to hold over the next 2 years, maybe a little less in 25, a little more in 26, but overall holding. And that's the average of all sell-side analysts covering. And I think that's where the real data is. The recommendations are a bunch of nonsense. 95% of all Wall Street ratings of all companies are currently still buy or neutral. So going between outperform, neutral back to outperform is kind of silly, right?
It means nothing.
The target prices are always all over the map. Super wide dispersion. It's not like there's a lot of information in that. But there is information on this. The fact that they're saying it's going to hold, and that's where they have the analysts put in the detailed forecast that you never hear about on CNBC or anywhere. This is not just EPS. This is their line-by-line forecast. Returns should hold. And then what the market's pricing in at their current level of 100, 170 or less, or 180, is that the ROIs will actually fall to really the lowest level they had all the way back in 2020. Now, you have to put this into context. This company sells services, equipment, software used by the companies that fabricate, that make integrated chips, that make semiconductor chips. And those are the chips that then get, sold by Nvidia or AMD. These are the materials, there are materials that get used by TSMC, that get used by Intel, by Samsung. By the way, these materials go into the products that go into not just AI chips, but also go into flat screen displays of all kinds, that go into other uses, that, cell phones, you name it, in terms of where these semiconductor chips go into. And so when you look at all those companies, where the expectations are there's continued growth and whatever else, this actually seems quite, I'll say, low of an expectation relative to their downstream, meaning their clients and their clients' clients have expectations of a booming next 3 to 5 years, whereas Applied Materials is being punished as if they're not going to be selling to the firms that are growing like crazy. And that's why this seems just really off.
And Joel, I mean, to your point, I remember, you and I were talking about this earlier, and you brought up the whole entire point that, hey, and also, if you see what's happening for AMD and Nvidia about, right, being able to sell more into China, right, that kind of probably tells us, wouldn't you say, that these issues that they're uncertain about that caused the ratings cut and the stock drop probably are overblown anyways, right?
So, of course, I mean, how do they know what's going to happen with Trump and everything else? And so they give an honest answer like, we're not sure. Right, and that uncertainty is sort of like punish the stock, and the Wall Street analysts have jumped on top of this punishment. When you'd say, is that really the case, though? Right? I mean, even the analysts in their 2-year forecasts, 2025 and 26, are saying, no, returns are pretty much going to hold. Even that seems low, given that they're selling to the companies that are selling to Nvidia and AMD that have such incredible lofty expectations. And you mentioned Nvidia and AMD, which recently the administration in the U.S. had said, we're going to allow you to start selling more chips to China than we had previously thought. And that it's, part of the reason is China's probably getting those chips anyway through a number of channels, and so why not just sell direct? But either way, the industries this company sells to are growing like mad, are expanding like mad, and yet this company is being punished for some reason. So these expectations seem kind of low. This is not yet a conviction idea for us. We're not saying go out and back up the truck, but it's getting to a point at some point we might say, oh, wait a second, this stock has gotten cheap enough. There's, a lot more upside than downside, and all we need is 3 to 1, 4 to 1, 5 to 1 upside to downside before we'd start saying, all right, it's time to get in. Maybe not right now, but man, would we have this on a watch list for potentially going long, despite what the Wall Street analysts are saying.
Exactly, right? So to hammer it home, right, I mean, you've got a company whose end markets between AI, booming need for chips, need to build out more fabricators, right? Fabs, makers of chips, mean you're going to need more of applied materials equipment. You've got recovery happening in a lot of the consumer stuff, and you've really got a lot of the issues in terms of import-export starting to lift. And yet the market's pricing this company like it's going to hit a nuclear winter for its profitability relative to history. That just doesn't make sense. And that's why Wall Street is wrong yet again. If you like this, by the way, this episode of the Altimetry Authority, hit the like and subscribe button and come back for next week. Thanks, everybody.